What if I told you the hardest part of investing has nothing to do with markets, interest rates, or timing? It's what's in your head: access, clarity, confidence. Most people think investing is about having money, but I'll tell you something uncomfortable. Money is the easiest part. If you don't have those three, you'll sit on the sidelines, or worse, invest in the wrong thing at the wrong time. And later, I'll show you how that one strategy that helped me stay liquid without ever needing to sell an asset. It changed everything. Today, I'll show you how the wealthiest families solve this and how you can too. I'm Ahmad Ashrafi, entrepreneur turned investor. I built and exited a company, launched my own family office, and now co-invest in structured real estate deals with other high net worth individuals around the world. And here's what I've learned. You can have liquidity, you can have an ambition, but without access, clarity, and confidence, you either park your cash in money market funds or get burned chasing the next shiny thing. If that sounds familiar, you're not alone. But by the end of this video, you'll understand how to see deals earlier, make sense of complex structures, and build an unshakable conviction like a family office pro. It's not just about investing. It's about transforming how you think about money itself. Here's what we'll cover today: the access illusion, why the best deals never hit the open market; clarity is a superpower, and how to decode any private deal in minutes; the confidence gap, why smart people still hesitate; how family office think, long-term frameworks over hype; and becoming a capital allocator, even if you're new to this game. Stick around, because at the end, I'll share a bonus strategy I use to fund investments without ever selling assets. And most investors never hear about it. Let me tell you about a friend who sold his company for about $10 million. Suddenly his phone was ringing off the hook. It was banks, wealth managers, pick decks galore. But when he asked for solid real estate opportunities, crickets. Or worse, leftover deals. We finally found him a multifamily asset in Miami. It was a quiet deal, off market, no pitch decks. Initial terms: 10% preferred return plus equity upside. 2 weeks later, the same deal went public on a platform. New terms: it was 6% preferred return, no upside. Same asset, 4-point difference. That's $40,000 annually on $1 million check. Over 5 years, that's private school tuition or a down payment on a second home. Think of early access like buying a Birkin bag direct from Hermes versus overpaying the resale market once it's been flipped. Morale? If you're not early, you're paying someone else's margin. So, how do you gain access? You have to build a network of trusted operators. Look for co-investment deals from family offices. Get on the LP list of reputable sponsors. Quiet deal flow lives in inboxes, not websites. If you're only seeing polished decks with countdown timers, you're shopping retail, not smart investing. But even if you do get access, there's a bigger question. Do you actually understand what you're looking at? Let's talk about that next. I remember my first private placement memorandum. It was 72 pages, footnote smaller than your iPhone font. Legal A's plus Excel plus financial jargon equals paralysis. But that complexity, it's by design. Confusion sells dependence. Clarity builds conviction. So I built what I call the real estate diamond, which is a decoder of 4 questions. 15 minutes, and simplicity over complexity. What can go wrong? Am I in debt, equity, or both? Is the sponsor aligned? And what's my liquidity path? If I can explain it to a 12-year-old using this framework, I walk. Ever had that moment where someone's pitching a deal that you're nodding, but inside you're thinking, I have no idea what this person just said? That's your gut telling you something's off. According to a FINRA study, over 60% of investors admit they don't fully understand the risk of what they're investing in. Clarity is your edge. Quick example. You're shown a 7% preferred return, meaning you get paid before anyone else. Then there's an equity kicker, a bonus slice of the upside if things go well. But no one mentions who controls the exit. Red flag. But even with perfect clarity, a lot of investors still freeze. Why? Let's talk about the one invisible barrier holding many people back: confidence. I've met founders who built $50 million businesses and still felt frozen writing a $250,000 check into real estate. Why? Because they didn't identify as investors yet. They were used to building, not allocating. Lack of confidence often hides behind perfectionism. We say, let me do more research, but we mean, I don't want to look dumb. I've been there. After my exit, I sat on a couple of $1 million in cash. Didn't trust the market, didn't trust the noise, so I did nothing. And inflation rate grew to 6% a year. That moment, it lit a fire under me, and I realized waiting is a risk too. And the longer you delay action, the more clarity you lose. Fidelity reports that 56% of affluent investors regret not investing sooner because of fear. Confidence isn't a trait, it's a process. It's the result of asking the right questions, running deals through a repeatable filter, and investing alongside experienced people you trust. Start small, learn fast. Don't wait to feel ready. So now that we've tackled the internal game, let's zoom out. How do the wealthiest families think about investing at a system level? Let's compare. A public investor versus a family office investor. One follows trends, the other builds thesis. Diversifies randomly, allocates with purpose. Focuses on return, focus on risk-adjusted return. Invest in product, invest in people. Family offices don't chase heat. They underwrite downside and protect principal. They ask, what's the worst case? Then they layer in the upside. They structure deals, set terms, protect liquidity. They look for preferred returns. That means you get paid before anyone else. Equity kickers, a piece of the upside. And debt with upside conversion, performance huddles. The sponsor only wins if you do. Let's make this real. Imagine Maria just sold her company for $12 million. She allocates 20% into high yet debt, 30% into stabilized multifamily, 20% into value add development, 10% into startups she understands, and keeps the rest liquid. That's a family office lens without needing a 10% team. As James E. Hughes Jr. wrote in Family Wealth, 90% of the wealth is lost by the third generation, not because of markets, but because of mindset. But knowing how family offices think is just the beginning. How do you apply that mindset to your own portfolio? Let's build your allocator lens. After I exited my company, I created what I now call the Building Capital Framework. It helped me shift from investor to allocator. Here's how I divide my personal portfolio. 20% of it is in yield focus, so private credit. 30% is in core real estate, which is stabilized assets. 20% of it in opportunistic, which is value add or development. 10% is in asymmetric, which is venture or crypto. And 20% of it I keep as liquidity or dry powder. It's not about chasing alpha. It's about controlling the outcomes. Think of your portfolio like a control panel. Levers for risk, income, growth, and cash. You're not just investing. You're building a wealth machine. Ask yourself, what are you optimizing for? Income, appreciation, legacy? Your capital should reflect your philosophy, not just what's trending. This is what it means to think differently. Allocate smarter. Build wealth that lasts. And here's the teaser. One strategy I use in this allocation, especially on the liquidity side, has let me deploy into new deals without selling a thing. We'll get into that shortly. Let's bring it home. The hardest part of investing isn't about finding the next hot deal or timing the market. It's solving for three things: access, clarity, confidence. When you unlock these, you're no longer reacting to deals. You're choosing the right ones on your terms. So here's what I want you to do next. Pick one of the three, just one. If it's access, reach out to an operator or join a vetted community. If it's clarity, build your own deal decoder checklist and run your next opportunity through it. If it's confidence, co-invest alongside someone experienced, or simply commit to learning by doing. Because clarity without action is just another form of comfort. This is how you shift from chasing returns to controlling outcomes, from investor to capital allocator. And if you're ready to think differently, allocate smarter, and build real long-term wealth, subscribe, share this with a friend, and let me know in the comments. Which one of these are you solving for? Access, clarity, or confidence? Let's build wealth that lasts, and let's do it the smart way.